think the most important thing to focus on will be any guidance these banks can give. Because if I rewind a couple of years to when the Fed started hiking interest rates, what the big banks were able to do was increase the amount of interest they charged on their loans, but not necessarily increase the amount they were paying savers. And so that net interest margin, the key profitability metric, and the difference between those two rates increased. And coming into this year, given the expectations for interest rate cuts, that margin was going to get squeezed. But as we've seen in the first quarter, and actually including this month, data suggesting later or smaller interest rate cuts, that margin could be higher for longer, and therefore there's an earnings tailwind potentially for those big banks.
One of the things that put a lot of stress on the U.S. banking sector, remember, we're just about a year away from the Silicon Valley Bank collapse, are big swings when it comes to interest rates. I'm looking just this week alone, we've seen a 20 basis point jump in yields in the U.S. and even here in the U.K. How do you see it impacting the ability of these banks to forecast ahead? And also, how do you see it impacting commercial real estate?
Yeah, I think that's a really good question. I think in terms of forecasting ahead, I think that the banks tend to be quite conservative in their forecasting, and so moves, intraday, intra-week, intra-month probably don't change the calculus too much, certainly on a multi-month and certainly year view. I think commercial real estate is still an area of weakness. I think we're going to see that particularly in Wells Fargo's numbers. That's going to be an area for concern. But I think what's probably more meaningful about these sort of movements is there are a lot of moving parts that give us a good sense of the strength of the U.S. economy and where things are.
Also the strength of these bank stops, does that give them some ability to be a little bit more conservative? I'm looking at the numbers right here. Citigroup up over 16% over the last 3 months. Wells Fargo, similar number. Does their recent performance give them the room to be a little bit more conservative? Because remember, just 9 months ago, there were serious concerns not only about the banking sector overall, its solvency, but possible consolidation and what that could mean. You're completely right.
It's a rare thing to be able to say U.S. banks have outperformed anything, right? Let alone the rest of the S&P 500 with the Mag 7 in there. I think if you look at valuation, they're around 12 times earnings on a forward basis. History has them around 10 times. There's a fair bit of optimism, I'd say, around certainly with the interest rate picture. So I think there's a lot of optimism baked in. Hopefully there's perhaps more to come, but I'd say it's within the bank's control at this point how much optimism they want to.
And most of that optimism was actually baked in up until the end of March. And if you take a look at the XLF financial ETF, which includes more than just the banks, it sort of got really, really strong at the end of March, and then it's actually been consolidating. A little bit of overbought situation is being worked off. So therefore, is there an argument going into this earnings season to go long the XLF?
Potentially. I think there's a lot sort of going, as you sort of alluded to, a lot going on beneath the surface. If I look at financials overall, I think there's an estimate of around 1% earnings growth. But within that, banks are going to be sort of down 18%. Insurance is going to be up. And so potentially, yes. But again, below the surface, there's a lot going on.
Do you feel, broadening it out beyond just the banks, that the current profit estimates that we are seeing, and of course Arabile laid it all out very beautifully for us, do you think that the current profit estimates justify the above average valuations that we're seeing in the broader S&P 500?
I think there's a genuine argument that it does. What I would say is if you strip out Mag 7 earnings growth, you're probably, at least for this quarter, going to have negative earnings growth for the S&P 500. But taking all the AI sort of hype out of it, what you are starting to see is companies use some of these potential benefits from AI to actually genuinely improve profitability, genuinely show earnings growth. And so if we get that 10% earnings growth this year and 10, 11% I think is what people are forecasting for next, then actually that does justify 20 times earnings.